Hello, fellow intelligent investors. My name is René Zellman, and today I want to continue to talk about Howard Marks' latest memo. And in this video I discuss why an investor not only needs to know when to sell a stock, but that the ability to hold on to a well-performing stock, so being aware of the risks of prematurely selling a position, is another crucial quality of an above-average investor. So in a way I will talk about investors' ability or inability to let your winners run. Let's get started.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Zellman, and I'll teach you how you can manage and invest your money with confidence, a long-term vision, and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Alright, before we get started, I just wanted to let you know that this is actually the last video of a 3-part video series. So if you haven't watched the other 2 parts yet, make sure to have a look at them as well. So, a common theme in the world of investing is the question of when one should buy a stock. And I think it is well justified to discuss this question at length and in much detail, because transacting at the right price should be a critical component of everyone's investment framework. But buying stocks is only one half of the discipline of portfolio management, and selling is the other. And in fact, I think there is another crucial component that is often overlooked when discussing portfolio management, and that is the art of not selling a position. I believe that a big factor in increasing the returns of your stock portfolio is picking exceptional businesses and then sticking with them for a long period of time. In a way, you need to learn to let your winners run. And this is a concept that Howard Marks too discussed in his latest memo. And before I share his thoughts on this topic, I just wanted to let you know that you could help me out a great deal if you just quickly hit the like button, leave a comment, or even subscribe to the channel. This would help me crack the YouTube algorithm and reach more people. Alright, so what does Howard Marks have to say about the art of not selling? Generally, his latest memo, titled Something of Value, was rather groundbreaking, as Marks is basically questioning some of the core principles he himself has adhered to for the past couple of decades. And to discuss the importance of not selling your winners, we once again need to distinguish between a classic value investing approach, in a way how value investing is defined by academia, and a more modern and maybe more intelligent value investing philosophy. Here's what Marks wrote. Value investors often look for bargains among the things that have come down. Their goal, of course, is to buy underpriced assets and capture the discounts. But then, by definition, their potential gain is largely limited to the amount of the discount. Once they've benefited from the closing of the valuation gap, the juice is out of the orange. So they should sell and move on to the next situation. So this brings us to the different sources of investors' return again. The 3 main sources of investment return are A, free cash flow yield. So that's a metric that compares the free cash flow a company is expected to earn against its market cap or its enterprise value. Then there's B, multiple expansion. So this means that you can increase your returns if the valuation multiple increases and buyers are willing to pay a higher multiple for a stock than you were in the past. And C, then there is internal business growth. So what Marx is pointing out in the quote that I just referenced here is that classic value investors that primarily focus on a firm's price and are looking for true bargains, dirt cheap businesses, naturally they will mainly benefit from the multiple expansion component. However, the key message he wants to bring across in his memo is that investors should focus more on the quality of a business and focus on high quality businesses that can grow internally at above average rates for long periods of time. The return of such investments, of course, will primarily rely on the internal growth of the underlying business. And generally one can say that the longer the holding period, the more important a firm's internal growth becomes, and the less relevant potential multiple expansion or multiple contraction, which is basically the opposite of multiple expansion, becomes or will be. And I have actually summarized this in the following chart that shows that the multiple becomes less important the longer your investment horizon. Howard Marks writes, "All that matters is thinking about how much cash flow the company can produce over a long period of time, discounting that at a reasonable discount rate, and comparing the resultant present value against the current price. There are lots of things about both the company's present condition and its future potential that don't get picked up in a PE ratio. So a high multiple alone shouldn't scare you off." Now let's say you have found an exceptional business that can grow at a fast pace for many years to come. A firm with a good capital allocator as the CEO and a wide moat defending it against competitors. Well, for some reason, most investors feel compelled to sell their investment following a multiple expansion, and usually under the premise that the stock is now overvalued. But let's assume you own such a compounding machine that is currently trading at an EV to free cash flow ratio of 30 or 40, 45. That business is still increasing its intrinsic value by a better than average rate, as it is an exceptional business, and as growth increases in intrinsic value. The main problem here is that there are only so many exceptional businesses out there, and it's hard to find a better alternative, a business of the same quality that is also available at an attractive price. So finding a better substitute can be incredibly hard. And another problem is certainly that once you sell an investment, you will have to pay taxes, and thereby you are also interrupting the power of compounding. And again, here is another quote from Mark's memo that stresses my point here. "In Graham's day, cigar butts could be found in good supply, valued precisely, bought very cheaply with confidence, and then sold once the price had risen to converge with the value. But Andrew argues that this isn't the right way to think about today's truly world-class companies, with their vast but unquantifiable long-term potential. It's impossible to accurately quantify that potential and know when it has been realized. He also may realize that ultimate potential is a moving target, as the company's strength may allow it to develop additional avenues of growth. Thus, he might have to accept that the correct approach is to A. hope he has the direction and the quantum approximately right, B. buy, and C. hold on as long as the evidence suggests the thesis is right and the trend is upward." And let me add this here. Saying that selling and the ability to hold on to winners is an important skill is easy. In theory, we can stick to the buy and hold investment style or philosophy. But in practice, it becomes really difficult. There are all sorts of emotions or human biases that may interfere here. Let me just name two here, like two biases. For instance, the action bias refers to the human tendency to feel less regret or embarrassment if they take action and lose than if they do nothing and still lose. And investors in particular feel like that they need to do something to improve their returns or to justify that they deserve their returns in the first place. But taking action can really work against you in the world of investing. Quite often, extreme patience is what will make you wealthy, and in fact, there are many studies that have found that high trading often resulted in low or poor portfolio performance. Moreover, human beings suffer from another psychological phenomenon called regret aversion. In a way, they are thinking, I'm just going to sell this stock here because I can't take the pain of seeing the stock go down. They are essentially locking in profits. And there's this famous saying that nobody has ever gone bankrupt from taking a profit. But honestly, I think that's a terrible advice. If you sold Apple at its all-time high back in 2004, you would have missed out on a compounded annual growth rate of around 40%. Surely it would have felt good if you locked in a profit of, say, 50%. But just imagine what missing out on like another 20,000% would feel like if you sold Apple back at its high in 2004. With dividends reinvested, it's probably even more. So in a way, if the story of your compounding machine is still intact, you have to constantly and actively talk yourself out of selling. Think of it this way. Stocks that make it to a new high, that's actually a good thing. because stocks that make new highs are usually stocks that will continue to make new highs. And Marx writes here, when you find an investment with the potential to compound over a long period of time, one of the hardest things is to be patient and maintain your position as long as doing so is warranted, on the basis of the prospective return and risk. Investors can easily be moved to sell by news, emotion, the fact that they've made a lot of money to date, or the excitement of a new, seemingly more promising idea. When you look at the chart for something that's gone up and to the right for 20 years, think about all the times a holder would have had to convince himself not to sell. And in addition to that, I think another major problem we human beings face is that we just cannot fathom the power of compounding. We just struggle with thinking 20 or 30 years into the future. It's incredibly difficult for us. I actually recently read a tweet that pointed out that if you look at all the stocks that have become a 100 bagger, so stocks that returned $100 for every $1 invested, well, the median time for a stock to go up 100x was 26 years. A 20% compounded annual return for 25 years will give you a 100 bagger. However, 20% compounded for just 20 years gets you to only 40x. In a way, this reminded me of the fact that Warren Buffett has made like 99.5 or 99.7% of his money after the age of 52. And these numbers just stress that compounding is just very hard for us human beings to grasp. Charlie Munger, so Buffett's long-term business partner, he once said that the first rule of compounding is to never interrupt it unnecessarily. Selling a position or even trimming a significant portion of a position in a company with a great compounding potential can be a very costly mistake. Charlie Munger himself, he has made almost all of his money from 3 or 4 successful investments. And similarly, Benjamin Graham, the father of value investing, he earned more from just one long-term compounding investment, namely Geico, which is a growth stock obviously, than from all his other investments combined. And if Munger or Graham would have sold these positions prematurely, this would have been a tragic and probably life-altering mistake. And again, Marx makes a similar point in his memo. In other words, if you have a compounding machine with the potential to do so for decades, you basically shouldn't think about selling it. Unless, of course, your thesis becomes less probable. Compounding at high rates over an investment career is very hard, but doing it by finding something that doubles, then moving on to another thing that doubles, and so on, is, in my opinion, nearly impossible. It's much more feasible to have great insights about a small number of potentially huge winners. Recognize how truly rare such insights and winners are, and not counteract them up by selling prematurely. So what's the big takeaway here? Well, I'd say in summary, extreme patience is an important trait to become a successful investor. In investing, doing less is often more. Just let time and the power of compounding work in your favor. You've got to stick with your winners and just ride them out. And as activity is more likely to hurt you than help you, just acknowledge that being lazy can be an enormously valuable quality of an investor. And with that being said, may your finances and investments prosper. Good luck.